Good afternoon, everyone. On behalf of ISM New Jersey, we would like to extend a warm welcome to all of our members, guests joining us today. We're excited to bring you another timely and insightful program. Today's session is titled Understanding the Recent Surge in Energy Prices, How Procurement Leaders Can Respond Strategically. We do encourage you to share your comments and your questions in the chat area for our speakers. The Q&A portion will take place at the end of the presentation. And now it is my really wonderful pleasure to turn the program over to our host, Len DeCanthia, who I've known quite a few years. He is a respected supply chain executive, member of several advisory boards, and also is a board trustee. At this point, I'm going to turn the program over to you, Len.
Well, thank you, Kathy. And I want to thank ISM New Jersey for helping to sponsor this event, this webinar, on this important topic. And again, as Kathy said, we're encouraging any questions. If you could put them in the Q&A section, that would be appreciated. And we hope to leave a few minutes at the end to be able to answer some of those. So listen, today we're going to be joined by Paul Shagawat and Dustin Scarpa, who I had the pleasure of working with over the past 18 months through our mutual affiliation with Rutgers University. And instead of sitting here and giving you the story of Paul and Dustin, maybe I'll ask Paul to start and Dustin to finish to get a little bit more background on them and the creation of Transparent Energy.
Yeah, Len, I want to thank you for taking the time to moderate this discussion today, and also thank Kathy and ISM for giving us this platform. Dustin and I have known each other for over 30 years, childhood friends, grew up in the same town in New Jersey together, both attended Rutgers, as you mentioned, Len. I sit on the Rutgers Business School board, humbly and proudly. But Dustin and I really got to talking about this concept for transparent energy when we were at college. We both worked for a very large retail energy supplier who had big generation access and a lot of pipeline capacity. And we kind of saw a massive disconnect between what institutional grade practices were used by the Federal Reserve and even the utilities themselves compared to what was going on in the retail markets and the approach that folks were taking. We both have a passion for bringing transparency and auction methodology for major institutions already trust these into the energy buying world. My background's in finance, economics, and efficiency, and so we really wanted to bring a new consulting methodology that brought that efficiency into the customer base.
Yeah, that's great. And for me, I think the timeliness of this is perfect, only because I live in New Jersey and lived here my whole life. I've owned a house for over 40 years. And my energy bill is soaring. The local community chat areas talking about these energy bills soaring. This morning, I saw another new contract being put in place with increased energy pricing. And then I hear about these data centers that are going in the size of Central Park. So, help me understand what's happening here.
Yeah, great question, Len. If you're in PSE&G or any of the four major utilities in New Jersey, you've gotten a notice like the one that we have up today. And this is actually going on nationally. We're going to be hyper-focused on PJM in New Jersey today. But it's really happening because of demand surge that, Len, we haven't seen since the Industrial Revolution. So the last 20 years, energy markets have been pretty stable. And there's two reasons for that. A lot of our manufacturing has went overseas. And we've also seen an adoption of energy efficiency projects. So that's kind of flattened the load. The only reason we've actually seen it kind of maintain the growth that it has is because of data centers. But now with this adoption of hyperscale AI data centers, we're seeing projects that we've never seen the likes of before. Historically, a big data center would be 10 to 30 megawatts of load. That Central Park project you're talking about, it's for 1.4 gigawatts of load, 1,400 megawatts. So now large is 300 megawatts to 1,500 megawatts. And if you don't speak in this kind of energy language, just to give you a sense, these projects are large enough to serve about 1 million homes in their energy consumption. And I know we're going to talk a little bit more about that. But what's causing the supply and demand economic situation where demand is soaring and supply is not necessarily where it needs to be? A lot of this has to do with infrastructural builds outs for new power plants. Those are going to take 5 to 10 years. We've retired some of our power plants that we already had, coal plants, nuclear plants. And although we've adopted renewables, solar, wind farms, hydro, The problem is resiliency issues, right? We don't necessarily know when the wind's going to blow. We kind of know when it's going to be sunny, but it might be cloudy or rainy. Then at night, we're not getting any of that energy consumption going into the grid. And so even though there's battery backup storage implications to store that energy, feed it back into the grid, that technology is not advanced fast enough. And economically, it doesn't always make sense to have those batteries standing by for some of these solar and wind farms. So we've reduced our power plants from fossil fuels. We've increased our renewables, but not at the same scale. And we're really stuck in this motion now where we don't have enough capacity to serve these markets. You mentioned you got some news yesterday, and we published some information about this. You already saw an increase in capacity pricing. Capacity auctions for last year were up 800%. Huge figure. The frustrating piece about yesterday's information is we're going to see those capacity increases an additional 20% on top of that already huge growth we saw for calendar year 2026 to June 2027. So there isn't a lot of end in sight in terms of this crazy volatility and these increased prices, but there are some solutions that customers can utilize to mitigate risk and reduce budgets.
But you mentioned like a reference, and I need a soundbite here. So,
Yeah.
9 million of us live in New Jersey, 3 million houses. Like a data center represents how many houses in New Jersey?
So that Central Park data center, that was just to give people an ideology of just how large the footprint. But the reality is we've seen hundreds of these press releases. These are projects where shovel is already in ground. For that type of project, which is about 1.4 gigawatts, it's over 1 million homes. In New Jersey, we have 3 million households. So 3 of those projects is equivalent to all of the residential consumption for the entire state.
That's an amazing amount of demand. So, when I had responsibilities as either a CSO or a CPO, energy at work for our many sites was like energy at home. The only time I really worried about it was when it went out, right? And we had a lot of talented people at the locations, at the sites, who were kind of, in charge of making sure that, we have our energy contracts in place, and they're basically keeping the place up and running. What's different today for someone who's at the local or at the front lines, Dustin? What's this dynamic creating?
Yeah, as Paul mentioned, I also want to thank the ISM community and also Kathy for having us. I really appreciate it. And I think this is a very pressing issue. So I'm happy that we're talking about it. But essentially, capacity prices, as you've heard, are skyrocketing, right? Volatility is really back in a very big way. We've had the benefit of some relatively flat years of energy pricing that have not overly rocked the boat, so to speak. In cases of today, one could say that the boat might be close to rocking over. But it's a bit of a crisis situation with these capacity prices in New Jersey and across PJM. And that's kind of escalating the conversation up to, in some cases, the CPO level. The C-suite is starting to kind of lean in and inquire as to, what's going on that is, receiving these letters that's causing capacity prices to jump so much. And facility managers are tasked with the responsibility of explaining to the CPOs why budgets are really exploding in many cases. So a lot of times when that conversation is held, the response is, okay, well, what are we doing about it, right? What can we do to combat some of this price change and some of this new volatility? And that's a little bit of the conversation that we're having today, which is, for decades, I'd say for the past 10, 15, 20 years, since energy deregulation, a lot of times energy has been purchased the same way, right? This is from 2005 to 2010, 2015, and present. The way that we kind of went about sourcing energy pricing at the beginning of deregulation is kind of similar to the way that we're sourcing it even today. But with the level of volatility you can see even on the screen with these capacity auctions, you need to see if there's ways to integrate a new approach or maybe a new technology that can help to combat or offset some of this price increase.
Yeah, and it's kind of a double jeopardy situation. So let's talk about the reality, right? We're sitting here saying, my home bills are up, but I'm sure, this is the case for businesses large and small, not only in New Jersey, but throughout the country right now. And and I call it a double jeopardy because it's my unit price is going up. And for many of us, these heat domes are coming across the country, so my use is going up. So I got price going up on a per unit basis, and my units of use are going up. And probably the tough conversation that I would probably be having with a CFO or a CSO or anyone in the organization is, these energy costs are overhead. So my overhead costs are going up. So I'm spending more money in overhead as opposed to investing in growth. And that's not a good thing, right? And that's probably what I would call almost a crisis situation. So the need to be able to manage that is going to be critical. And what concerns me is, as a CPO at very large CPG and life science companies, energy really didn't cross my desk as a strategic category. It was kind of local and decentralized. And, we had some consultants who would kind of give us heads up here and there. But what is different about your approach? Because this is a bit of a call to action right now. And if we are going through a significant structural change, I'm going to have to do things differently if I'm going to be able to be effective and being able to manage these costs while we're in the middle of the structural change. So Dustin, how is this different than my traditional consultant, 3 bids and off we go?
Yeah. So, the thought of, movie quotes, desperate times call for desperate measures. With capacity rates spiking and in general, as Paul was talking about, the infusion of demand, these data centers, the combination of that is really changing the dynamic of the energy landscape. As I mentioned, when energy first deregulated in the early years, prices were relatively flat. We've had major events, we had the polar vortex and things like that from time to time, but most of those events were saddled by 3 to 5 years of relatively flat pricing. So there hasn't been a push, a major push, definitely not from the sea level to really combat this from an approach or process standpoint. One of the things Paul mentioned, one of the ideas behind transparent energy, even as you see on screen, right? PJM, when they're sourcing their capacity prices.
Hold on a second. Who's PJM? I don't know who they are.
So that's the major grid that New Jersey, resides in. Pennsylvania, Jersey, Maryland. There's other states. That's our grid, which services those states.
Okay.
So, and thanks for clarifying that as well. PJM themselves, when they need to source this commodity, when they need to source capacity, they use an auction approach to do that. They have their counterparties that they bring to the auction, and that's what they use to source their pricing. Other major institutions, even at the utility level, not just the grid operators, but even PSE&G, JCP, and others, they use auctions when they're procuring wholesale for the accounts that are still remaining on PSE&G supply. They use auctions, wholesale auctions, to kind of set their pricing. As you see on the screen, major institutional organizations use this approach really for commoditized purchases. The Federal Reserve, they'll use an open market auction to set that the interest rates for treasury bonds and such. Organizations like the Chicago Mercantile Exchange, they use auctions for many of their futures trading. And as Paul elaborated, when we were at Rutgers, we were thinking about how can we bring the approach that the larger players utilize down to the individual business operator, the individual facility, individual customized approach to that extent. When the markets have been relatively flat, there hasn't been such a need to start to investigate this technology adoption. But what Paul and I found was, in most cases, across many other categories that you're managing on the procurement side, technology has played a role or has changed the approach. When it comes to energy sourcing, because the market's been relatively flat, the approach has kind of stayed the same. that's kind of getting turned on its head now with the auction results from PJM's capacity prices. I think capacity alone was up about 800% year over year. So when you're starting to see that kind of volatility in your pricing, helping to mitigate some of that impact, maybe getting a little sharper with your own process and with the suppliers can help to offset some of those increases.
So the people that I'm dealing with at the first level, or my first level supplier, are the people that are creating the piping, right? The juice that not the juice, but the piping that gets the juice to me. I'll give you an analogy. In one of my CPG positions, we did a lot of cardboard and cartons and cases and all of that. And we decided the best way to kind of manage the cost of the raw materials is to go out and buy a forest, right? Because they were all paper supplied. So what we're basically saying here is we have the opportunity to kind of do the same thing here. And instead of working through our level one supplier, we can go to the actual raw material, the source supplier, which is the energy generator, to be able to possibly consolidate our buying. And auction technology or auction processes are the processes that are commonly used. But Paul, we've been talking about auction technology for decades now. Is the adoption rate high in this space?
Yeah, that's a great question, Len. Independent studies have shown that less than 25% actually use technology for energy procurement events, despite it being one of their biggest controllable expenses. That's not what you see in other categories, in other business operations. There, you can see on this chart here, over 60% for financial services utilize some sort of technology platform. That could be a SaaS software solution, or it could be AI, but they're using digital transformation everywhere except those energy categories. And what that gives you, Len, is kind of an archaic way of going about procuring your, one of your large expenses. It's a relationship-based dependency where you rely on a certain small group of suppliers to provide you with the information and pricing. What we're bringing to the table here and what auctions bring in general is a market-driven approach where there's a competitive market discovery utilizing technology. It's actually a platform where you can activate all of the generators, all of those that have natural gas pipeline capacity, to openly bid on bespoke RFPs that are created based on customers' risk tolerances and different term lengths and product types, and whether they want to go green or still buy traditionally. All of that can kind of be incorporated. And that digital transformation that's happening everywhere else, C-suite is starting to begin to insist on, right? That technology penetration. And Len, you were talking to me yesterday actually about you insisting upon that and using this even in automotive purchasing auctions 20 years ago, right? And that expense wasn't nearly as high as J&J and others' energy expense and energy budgets. So we are starting to see some people actually understand that there's these major changes. We're just trying to educate them on how the technologies can help them reduce human capital. So actually it takes less time. They become more efficient. They get more market data that they wouldn't otherwise have. There's competitive bidding, and you're truly able to give yourself an opportunity to make informed decisions that best benefit your organization. When Dustin was mentioning earlier how some of the big players are using these auctions like the utilities, big players are really just those that own power plants. So there's very large chemical manufacturers and data centers and healthcare companies, whether they be in the life science research and development, and a lot of those folks are still using paper-based RFPs, emailing, phone calls, spreadsheets, and not integrating any type of technology, right? So procurement departments who already are using sophisticated platforms for other commodities need to revert to utilizing this type of system within their own organizations for their energy spend, especially as we see those prices soaring.
All right, let's do a couple of lay of the lands, and then I want to talk a little bit about practices. Lay of the land, how many states in the United States are deregulated?
For electricity, 17 states, but those 17 states make up roughly 70% of the energy consumed in the United States, so it's a very big chunk there. Yeah. For natural gas, almost every state does have energy deregulation, so you are actually able to get competitive pricing in the outside markets.
So we're talking about electricity and we're talking about natural gas here.
Yes, and we also talk a little about renewables, and those really, it's not so much geographic. You can buy renewables throughout the country and in Canada as well. And so these software solutions kind of help any customer, whether it's power, gas, renewables, with a real focus on those 70% of users in those 17 states.
So when you say renewables, if I have a 2030 goal or a strategy around renewables, I can integrate that strategy with my sourcing strategy around moving my energy buy based on my utilization to a mix that is probably more favorable or fits where my organization wants to be in that space around renewables. Fair?
You nailed it, Len. We run auctions for all different types of renewable products. One of the things that we're seeing a lot of is bigger companies like a Google, right? But it's a small handful. They understand this auction. They've written a white paper. The only way to buy energy and renewables is through auctions. We've written a white paper with Urban Land Institute, one of our partners, in that same type of education, right? And so the bigger adopters are doing just this, right? It's the only way to actually be able to reduce their budgets when it comes to energy spend and to incorporate a lot of those renewables. So you're absolutely right. You can use this technology for traditional energy buying or renewable energy buying. We just want to see it incorporated by some of the smaller players. And by small, I still mean the Fortune 1000, because even within their own practices, they're not quickly adopting to this technology and then really driving results.
So if you're in the reactive mode, if you're late to the process, what I'm feeling, right, is the early adopters are probably going to lock capacity at a favorable price. When I'm coming to the table late to the party, I'm willing to pay a lot more to lock capacity, I am going to be paying a lot more. So they're kind of locking things down. So Dustin, if we're going to have a new practice here, I grew up doing, okay, the only way I know what the market's like, I got to do an RFI. And then once I go through the RFI, I can't handle 8 different suppliers. I have to break it down to the RFP, usually the incumbents in there. Then we do paper bidding, and I have a consultant writing a book and charging me a lot of money to tell me how to go to market, and on and on and on. And I'm usually starting this process like 6 months, if I'm good, maybe sometimes only 3 months before the contract terminates. How different is this process? Is this process wait for 3 months, or I see people buying capacity for 2030. So, how is this different than the way I've done it in the past and using consultants and paper RFPs?
Yeah. So as I was mentioning before, the approach that's been consistent since the beginning of deregulation has really been kind of standard operating procedure across other categories, right? That just applied to energy when energy began to deregulate. So the one thing that's unique about energy in particular is that it's 100% commoditized, right? Based on the way that the deregulation was written, the supplier is really helping to set the supply rate, but all of the other components, the delivery mechanisms, the wires and pipes, the invoicing are all maintained by the local utility. So utilizing a more hyper competitive approach to help to secure the price, it just can bring more intrinsic value to the process versus some of the approaches that have been used for the past maybe 10 to 15 years. A point on that is also, what are you really giving up to go to an auction, right? Is something to kind of understand, right? Am I taking on more risk by going to an auction versus maybe sole sourcing or leveraging relationship purchases? Again, the two things to reiterate on that are no matter who wins the supply auction, all of the qualitative components remain the same, right? Through PSE&G, the invoicing and whatnot. So the perception of giving up more of a relationship is I think an area that is a little bit being disrupted, and understanding kind of what is that relationship really worth at the end of the day, right? The perception of that. And I think
get the impression if I'm selling energy into the grid, I don't really know where that energy is going. Where that's being managed is at the delivery stage. Is that fair? So as a supplier, I don't, I'm just sending it out there, right? Is that a fair assumption on my part?
Exactly. Yeah, you're sending it into the grid, and it doesn't, all that matters is the piece of paper that you're holding, right? You could be sending energy into the grid to one customer down the street.
Yeah. Because
$0.07.
when I did this and all the change management, you're upsetting me, and you're my supplier. You're getting in the middle of all of this, and you don't know my supplier. And the reality is that relationship stays, and all the invoicing and all. What we're talking about is way upstream, where the cost is really where all the cost lies, right? And
Yeah.
so for you, Paul, so I'm an incumbent supplier. I'm one of these big players, Constellation or all these other folks, and all of a sudden you want to auction. Am I going to feel like, as an incumbent, that I'm being phased out, I shouldn't participate, or because this is all happening so far downstream, I have no idea what's going on there. Why would I want to not participate?
Yeah, the incumbents participate in 100% of the auctions we run. The difference, though, is they don't win 90% of the auctions we run, right? You asked a little bit about timing, and I want to speak to that. Historically, the Fortune 1000 uses a consultant or broker that's coming to them 3 months before an energy contract is expiring. It's not nearly enough time, right? They're not checking in with them biweekly. They're not meeting with them at least a year in advance, sometimes 18 months in advance, to take advantage of low points within the market. You talked also about laggards versus innovators. The innovators are the investment banks. They're already playing the wholesale markets for energy, so they want for all of their own assets to utilize auctions in the retail market. So they're very large energy users. The laggards are all over the board. It's every vertical you can imagine, Len. It's folks that really just haven't brought this level of sophistication in and maybe haven't been educated about it. But why do the suppliers participate in the auction when we're going to reduce their margin? There's several reasons. One is that there's going to be a decisive outcome guaranteed. The customer is ready to purchase that energy on that given day. It's not a series of rounds of refreshes, a very long sales cycle. And so even the cost to acquire said customer is much less because the consultant's doing all the work to bring all that load to the market. And we're bringing significant load to the market on a daily basis. So it eliminates that lengthy sales cycle, as I mentioned. They also get a lot of data. Maybe their curves are off. Maybe they're not very competitive. They're actually able to see all the different generators in that area and where those prices are coming in at. So they're gaining some market knowledge about, hey, am I competitive? Am I not competitive? Should I even be playing in the space? In addition to that, and this is a word used a lot, is orchestration and methodology. It's evolved to benefit both sides. So it benefits the customer because they're going to be getting a lower rate. They're going to actually have a reduced margin in terms of what they're paying to the supplier to be able to serve that energy load. But the suppliers are getting that data that we discussed, and they're also getting a lot of market capture. They're getting a lot of access to customers that they would never have before. So we have over 90 vetted suppliers in the country. That's every major player that you'd want to have access to that can actually serve your energy needs from a power and gas and renewable standpoint. And they're actively competing in all these auctions because they know at the end of the day, they'll lose the opportunity if they don't. They'll lose the data. And ultimately, it'll be more expensive to try to acquire a customer.
Yeah, because in my experience, you have like a 5-year capital plan. I'm sure they have a 5 or 10-year capital plan. They're investing in capacity, and they need to fill that capacity. So auctions becomes an efficient marketplace because it's opportunistic. I'm willing to sell capacity possibly at a better rate so that I can lock it down and meet my overall business strategy. So if I'm doing it at a point to point in a period, at a point in time, like an RFP, as opposed to a dynamic marketplace, I can be opportunistic as a buyer because I have 10 or 12 that are participating that, some might be sitting on a lot of capacity they need to sell, and it might be getting more favorable pricing, and others are just kind of going along for the ride to see what the capacity is going for to feed into their capacity investment profile. Is that fair? They're getting that type of market knowledge that they can't get anywhere else real time.
You're absolutely right. That's exactly what's taking place. But also, we think of capacity. We've had a lot of conversations about it. There are other ancillary line items, including just the cost of wholesale energy as a whole, that they're learning information about. And we can look at different products for customers. We can hedge that capacity. We can hedge that actual wholesale energy cost for those customers. And so that really is the benefit. I just want to give an example on timing, Len. Global pandemic, right? You felt it more than most of us, right? With your background, okay? Nobody could have predicted it, but you can react to it. So during that global pandemic, headlines were made. Oil prices went negative, right? We had never seen that before. Natural gas prices hit historical lows. What did the private equity banks do? What did the investment banks do? What did the Fortune 50 do? They saw that. They listened to some of our market intelligence and independent partners. And they said, we want to hedge our power and our capacity as long as we can while the market is at this low, right? And they did. They bought 5 to 10 year contracts where they're still protected all the way out to 2030. They took advantage of that market. We actually are at one of those precipices right now, Len. We don't have a crystal ball, but you can, every economist, the EIA, they all make these predictions and they're all bullish. There are very few bearish signs, right? And so in order to take advantage of that, you can see this speeding truck coming at you. You can see the train get off the rails. Don't bury your head in the sand, right? You go out to market now, you make those hedges, you use a comprehensive technology platform to do so. So, not only are you going out at the right time of the market, you're getting the lowest price based on market conditions. And that hedge is made into the future. You put up the rails for your organization, you don't go outside of them, and you're able to move on with the other aspects of your organization that you need to run.
Yeah, that COVID analogy is great. Like if in 2019, if our team at J&J knew we were going to make a vaccine, yeah, sure, I would have went out and bought capacity in terms of vials and you name it, right? And that's the one thing with energy as well. You talked about the 3 months beforehand, but the reality is, whether I have sites today or I'm in mid-flight of building sites or I have future sites, you can actually become strategic, right? Working with an organization like yours in auctioning and getting this capacity to align it with investment that's being made at the energy generation say, because my greatest fear and my greatest fear for companies I still own stock in, let's leave it at that, right, is if they're not doing that, they're going to be paying a lot more for energy than their competition. And that money is overhead, and that's money that's not being put into R&D or new innovation, and that doesn't grow the business. So let's pivot here. Let's get started, all right? And, give me some real numbers. If you're telling me auctions are more efficient and it's an efficient marketplace for buyers and sellers, what kind of results are you seeing in auctions versus traditional 3-bid RFPs process?
Yeah, no matter what the market conditions are, the auction is driving 7 to 8% lower pricing. There's a reason for that. It's some of that timing you discussed, Len. It's having a bigger supplier pool. So historically, what folks do is they go out not at the right time, 3 months before contract expires. They go to 3 suppliers, but for some reason, the incumbent wins 90% of the time, right?
Right.
Our goal is not to kick the tires and just to prove that the incumbent supplier is the right solution. We're agnostic. The auction technology is totally agnostic. It's happening live in front of our customers, right? And so they're actually able to see 12 participants that are bidding into a platform. This is from a real auction run last week for a very large investment bank. These auctions are set for 15 minutes. There was so much bidding, Len, it actually went 53, 52 minutes, because if there's 2 minutes left, we add another 2 minutes, and there was that much bidding. We actually got 271 unique bids. Yeah. And we tested a series of different term lengths and product types for the customer. And at the end of the day, within 15 minutes after the auction, they were able to make an informed decision, put together a 5-year hedge for their energy needs, and really took advantage of the market today instead of suffering through where the market's going to be 3, 4, 5 years down the line.
Yeah. So, and one of the things I learned, and Dustin, maybe you can help me with this, is if I say, okay, walk me through the process as a client, do I need to put 15 people on it to go through all of my data that's pretty bad in the first place? Do I need to upset and disrupt people that are working on other things in the organization? Walk me through what the client sees in this process that they've never seen before.
Yeah, that's great. And to piggyback off of some of the things Paul was saying as well, when you do look to potentially conduct an auction, much of the data that we need to do that, can be pulled directly from the utilities. We can pull it directly from the utility company. We can pull the usage profile. We can have a conversation about, demand characteristics, and we set the parameters of the auction jointly. So it's not. Is it
the people that are feeding me the juice have all that invoicing data and all of that load data? Is that what you're saying? Is that where it comes from?
Correct. Yeah. The ability to pull that from them, we can just tap onto the utility and pull the invoices from them. And also, if you're working with a bill management company as well, they usually will provide access. But the other thing I want to speak about in terms of what you would see, right, is a byproduct of this is you really can condense the amount of time spent, right? So if, as Paul mentioned, most of these auctions are 15 minutes in nature. But if it's a very attractive load or a very attractive customer name and a market share, the suppliers can continue to bid, and there's a 2-minute reset feature, as you see on the screen. But you're really condensing what could be a multi-day, a 2-day, a 3-day, or a 5-day sourcing exercise. Reaching out to the supplier, getting initial quotes, having the conversations, maybe going back and getting a last and final. That can sometimes expand and be over the course of 4 days. This process, utilizing these platforms, the reason why, again, like PSE&G themselves and PJM use this is it condenses so much of that, the need for refresh, which at the end of the day, a client would see a pretty substantial reduction in human capital as well. The amount of time, if you're managing a great number of sites, this could really reduce the human capital. And a final point to make, what you'll see, and we're seeing this across the board this year and even a little bit of the end of last year, is as the auctions really starting to get active in the end, you're seeing that margin compression. But really what you're seeing is the removal of time risk premiums that are really embedded in what would be a static quote. And historically, when the market was flat day over day or week over week, the need for a supplier to embed padding or a time risk premium into a static submitted bid was negligible in 2005, 2008, and 2015 until 2019. But enter all of this volatility, all of the demand spike with AI and with these capacity auctions, those time risk premiums have become really substantial when kind of using a standard process. So what a client would see in this change is also all those little dots at the end are really the supplier stripping out that time risk premium that they had calculated in there, maybe in the sealed bid round. And it's becoming meaningful dollars. Time risk premiums are probably double this year, in some cases triple than they were in an early deregulated year, 2005, 2010.
All right, so I'm bought in, right? Let's go back 3 or 4 years. I'm in my office in New Brunswick. I run upstairs. I talk to the CFO. I say, look, we got smoke on the horizon. I was on my exercise bike in the basement this morning, and I saw that Constellation's stock is going up 20%, and energy costs are going up. And I'm going to be talking to Paul and Dustin today. And so you come in, bookend this for me a little bit, Dustin. Give me real experience now. The time frame from your most complex client that you've worked with, and that's probably a lot of multiple sites with multiple use, to some of your easier, the point of getting a go ahead from Len that says, what, we're all in. Here are the key contacts to get the information you need. How long is it going to be before we're sitting in a conference room in New Brunswick and I'm watching the event for all of our energy needs?
Yeah. That's the big question, right? And I think that's a little bit of the hesitancy of switching to a new approach is I'm going to spend double the time getting reoriented that I am actually doing the sourcing event. So we serve clients with over 5,000 locations, and we serve clients with 15 locations. I think getting an understanding of how this process can bring intrinsic value or intrinsically enhance the results is really important. But the time to enact this is a matter of getting understanding of where are the energy contracts today, where do they sit, how much time is left on them. But it's really important to understand whether there's 15 locations or 5,000. You really want to group the facilities by region, right? By ISO. So no matter the size, small and large, the amount of time, the cycle time to run these auctions is equal, whether it's for 10 facilities or for 1,500. You would organize the different facilities that you operate by ISO, as we mentioned, PJM, you have New York ISO, NEPOOL, ERCOT in Texas, and then you would orchestrate those auctions. So the timing, once you have got a good understanding of where the contracts sit today, it's not all that different from a cycle time, whether you're auctioning for 10 facilities in PJM or 1,500 in a certain.
How many average days is that from go to event?
Yeah, from start to finish, I mean, you can be up and running an auction within 15 days.
So 15, let's say 15 to 30 days is a realistic number.
I'll give an example.
And I'm getting 6 to 8% on average value. And I'm locking in based on decisions I want to make 1 year out, 3 years out, 5 years out. Is that what we're saying here?
Yeah, I mean, you're able to auction multiple terms simultaneously. As you can see, even in the image, the red line representing 12 versus the green line representing 36. But a good example is, we engaged with a rather large operator, and when we got in there was many contracts that actually had expired. They had over 200 contracts, which was about half of their portfolio, that were on expired contracts. There was some turnover internally that kind of created this. And we were able to orchestrate and facilitate over 200 auctions for this company within one full week, Monday to Friday. It was a busy week for us and for our operations folks that run these auctions. But, we ran auctions for 200 facilities in 1 week. So it was a pressing time for them because they were paying a premium on these holdover rates. So time was of the essence. And the value was of the essence to kind of run these auctions as quick as possible. But you can run these within 15 calendar days.
So Glenn, can I just add? I remember this customer well. We're bringing 7 to 8% better value. This customer actually saw a 32.7% budget reduction year over year. So the budget reduction can be very large, right? This is a customer in crisis. We had to act quickly. We were able to pivot. Our fantastic colleagues here, but also our technology is why we were able to go so quickly and give all that market information and execute these contracts. But the budget reduction for this particular customer was very high.
So what I found in my career, when you start kind of picking up the rocks, sometimes you find a scorpion here and there. Like you were saying, we don't have a contract. We haven't bid this for 15 years. We've been, and so that's not even, so what you're saying is when you start looking at this, you're going to find some things that'll clean your overall. What I like about this model is it sounds like my resource investment is minimal. My opportunity is using your organization as an extension of my sourcing organization, but you're not disenfranchising my level one supplier relationships. You're going way upstream, or you're taking me to a place where man has never gone before, right? Where sourcing has never gone before, except for these companies that are early adopters that are eating this stuff up, or the real smart people that are investing in these AI data centers or these Bitcoin, miners and whatever else. So they're creating all this demand, and they're getting all the best rates because the rest of us are kind of in a coma over here, thinking that the world hasn't changed, right? And so the issue here is an issue, I guess, of understanding and education, and then on your part, probably the opportunity to use all of this best practice experience that you've had over the past 20 years and start to bring it to verticals like life sciences or CPG or auto and electronics and others who need to kind of make this jump quickly, or else they really are going to be in a situation that they're going to be paying that higher rate and possibly running into reliability issues. So it doesn't sound like, and maybe Paul, you could agree or disagree, it doesn't sound like this is kind of a transient event. It sounds like this is a shift in business practices where energy now has become a strategically critical raw material for organizations that are going to have to not only plan for today, but plan for tomorrow, because tariffs are forcing us to start building plants, right? And start to do more investment in this part of the world.
Yeah, Len, I agree with you 100%, but you don't even have to take my word for it, right? Every publication in this country, you can't get away from it. Every morning in the newspapers, or if you're watching any of the news networks, they're talking about energy. They're talking about the surge in demand. They're talking about the change in price. You're getting these notifications sent to your homes and your businesses. So yes, this is kind of a cataclysmic shift. It's here to stay. And those that are those laggers we talked about, it's going to be difficult for them to continue to have success within their organization. And this is not limited to your medium or even large customers. We have a customer that's in the Fortune 10, and they were working with a nationally recognized asset manager. And they came to find out that their processes were wildly inefficient. And so we were able to help them very quickly get the technology involved, and they went from laggard to innovator. What they've done is innovative all throughout North America, all the different states, all the different facilities. They now have a lot of risk mitigation. They were able to buy all renewable products and still be able to do it with budget reduction. So there are opportunities for folks to act now during this huge shift, because we're not actually feeling all of the negative results that are going to come from these price increases. We're starting to feel it now, but the expectation is it's going to continue to go up. So you can do something about it.
But so let's just see if I understand your model. What I like about your model is you guys are staying in your lane, right? It's not a situation where, Len sits on this webinar and then I go back to, big cost consultant ABC and say, hey, I sat on this webinar on energy. Are you guys going to solve our energy problems? You don't consult, right? You consult in terms of supplier relationship management or market dynamic. You're very much focused on the transaction piece. What you have that's different than what they have is what?
Yeah. So before, when you were asking about how do we work with these different folks and are we taking their jobs away from them or making them look bad, it's just the opposite. It's a collaboration, right?
And you're not taking work away from consultants either, who don't have the what capabilities do you have that they don't have? Right?
Yeah, what consultants will do is they'll charge you a lot of money to give you a roadmap. Now you have a roadmap. How do you go and execute said roadmap? How do you do it without increasing human capital? How do you do it efficiently? How do you do it in areas where you get more data and able to reduce budgets? How do you get to your renewable goals within your budget, right? So it's really that collaboration. What we have that they don't have is we've run 11,000 auctions. We have all the major suppliers for power and gas in the country trained on the platform. We have market experts internally that create bespoke RFPs. And when I say collaboration, we need to work with the experts of these large organizations. They know how the facility operates. They know what energy efficiency projects are doing, if they're involved in demand response, what's going on at the site level. And we work with them to create the RFP that they want so that they can go to market and get, in this case, 271 unique bids in less than an hour. And so for them, we're reducing their human capital. What used to take them weeks or months now takes hours, 3 to 4 hours. We probably are utilizing for a company with a portfolio. We're doing all the work behind the scenes, maybe 70 to 80 hours, and then we're going to market. And that's where that 10 to 15 days, business days, comes from.
Right. So yeah, go ahead, Dustin, I'm sorry.
The two things that I think that you mentioned, what would you kind of gain? We speak about this very much with our procurement partners and our clients at these folks, but the auditability that you gain from this is pretty significant, right? You're getting to see every supplier's initial price, how many times they undercut or compress their own price, and the delta between that initial price and the final price. That level of auditability, you don't get to see it very often in most larger consulting processes. That's the intrinsic value. That's the hundreds of thousands, if not millions of dollars of value creation that you're expecting. So auditability is a really big part of that.
That's a big positive, right? So I'm not going to go in. So so we kind of played you're in Len's office and I'm asking you to do this. My question always as a supply professional is, how much is this going to cost me, right? And I'm not going to go into that on the webinar, right? Because it's a bespoke process, depends on locations, it depends on complexity. But I would encourage many on this who might have those types of questions and to learn more, because I think on the chat we have kind of the link to Transparent Energy with all the contact information, and really encourage people to at least think about this, because you don't have to jive into the deep end of the pool. Am I right in assuming that you can do a pilot and use the pilot as the ability to scale the opportunity and then quickly scale. Is that a fair opportunity for those who might say, well, this sounds too good to be true, and you know what they say about that? Can I do a test and learn that's easily scalable?
Yeah.
You nailed it, Len, especially with portfolios. We're
Right.
probably doing one of their large assets first. It's a pilot. If they don't feel like value is driven to them, they don't have to move forward. But we find that once we run that pilot, we quickly adapt to the whole portfolio.
Got it. All right, so we're getting down to the last few minutes. And I do want to use this as an opportunity, I think, for Paul and for Dustin to leave, let's say, if there's anything you want anyone who's listening to this webinar or will be listening to this recording when we distribute it, what are the one or two key takeaways you want from those that are going to be listening or have participated today? So I'll start with you, Paul, and then I'll jump to Dustin.
Yeah, I want people to take away the education about what's going on within energy markets. Crazy amounts of demand, not enough supply, causing volatility. And then what can I do about it? And for me, my education, everyone would be act as early as possible, work within the auction platforms, get all that data information in front of you, and then take the measures necessary to, like I said before, put up the rails and make sure you don't go outside of them because it could really hurt your organization.
Good. How about you, Dustin?
Yeah, the simplest way is a real-time moving purchase requires a real-time platform. That's just how it is, right? The main thing to take away is the need to strip out time risk premiums has never been greater. In the 2000, like as I mentioned, 2013 to 2020, energy markets were rather flat, and the risk premiums that suppliers would embed in a static process weren't tremendously significant. Now, with the amount of volatility, there's new headlines every day that time risk premium that a supplier would put into a static price submission, an email, or even a phone quote that's going to remain out there for 4 hours or 24 hours. Those have grown significant. So the need to strip away those time risk premiums have never been more critical to the company, right? The amount of volatility that's entered the market isn't really being counterbalanced with buying procedures adapting to that volatility and that real-time movement. So that's definitely what I would emphasize. And getting an understanding of what are you really getting in your supplier relationship, or the perception of the supplier relationship, right? What are you really getting for that at the end of the day, right? If there's a major legislative change or change in pricing mid-contract, and you reach out to ask your relationship provider to change or amend the contract midterm, I've been doing this for 17 years. You have a less than 1% chance that they're gonna change the contract term to the tune of hurting their own company.
Right.
For you. So on that doomsday, when you do call on them and you need them, they're not going to just swallow $300,000 to change a contract term, as much as you may think that they will or that they like you. It doesn't always work that way.
Yeah. What I love about the model is, I've always seen supply management, procurement, supply chain, it's an incredible enabling function, right? And if you're on the supply chain side, you're very focused around the delivery of your good and services. If you're on the procurement side, you're really trying to do your best to bring insights and to enable budget owners and internal business partners an environment that allows them to be extremely successful. And I think this is just a great opportunity to get a little bit more knowledge and expertise in an area, to introduce a relationship like a relationship with Transparent Energy as an extension of your organization and function, expertise that you can leverage, but expertise that allows you to continue to focus on what grows your business without being impacted. Because look, like I said when we started the conversation, I don't think about energy until the lights go out. I assume it's always going to be there. But now is it always going to be there, and at what cost? And that's a whole new world. It's a whole new world. And I really encourage, people to reach out, to learn more about this topic, and to really see it as a strategically important to the future success of your respective organizations. So I'm going to thank you, Paul, and thank you, Dustin, so much for participating. Thank you, Kathy, ISM New Jersey. I'm going to turn it back to Kathy for any more announcements for her community. And I encourage everyone to really do a little bit more digging into this. It's a critically important topic. Thank you, Kathy.
Oh,
I
thank
see there
you.
was a question. I don't know.
Mhm.
Sorry, Kathy, go ahead.
Yeah, go ahead. Go ahead. Yeah, we can definitely answer the
I
question.
see a question from North Carolina. I don't know if we have time for it, but you want to touch on that quickly, Dustin?
Yeah, I mean, pretty much the entire kind of the U.S. is open for natural gas. We run these auctions for natural gas, electricity, and renewable products. So natural gas is an option in those markets.
Great. Thank you. Thanks for picking that up. Okay, Kathy, back to you.
Okay, no problem. Well, first of all, I
Len.
want to say thank you to Len, Paul, and Dustin for coming in and speaking about this important topic, and to our audience as well. In 2 weeks, we actually have another topic that's important. We're going to be doing Tariff Talks 2025. So hopefully everybody can join us for that one as well. But at this point, we'll close out the program and say thank you again.
Thanks again, Lenny, Len, Kathy, all the ISM members. Have a great day, everyone.
Okay, thanks so much.
Thank you so
Bye-bye,
much.
everybody.
Have a great day.